Hello, very good morning to all and happy Friday. My apologies for slight delay because there seems to be a bit of a technical problem over at my end. So I hope that it has been resolved. You guys can hear me clearly and loudly at this juncture. All right. So very good morning to all and happy Friday. I'm Kelvin here. Welcome to today's Daily Dose of Market Insights. Today will be Friday, the 11th of April 2025. So as usual, before we jump straight into the gist of today's technical analysis and as well as today's daily dose of market insights, let's cover the things to look out for in terms of events and news flow. Let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. Right. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. Mic test 1 2 3. Test 1 2 3. I hope that the voice is as good as usual. All right, great. So my apologies because just now there was a slight technical error. All right, so very good morning. So as usual, let's have a quick look at what has taken shape yesterday first in terms of news flow, economic data release, and as well as their impact on the broad-based cross asset classes. So yesterday, one important economic data release is more pertaining to the US economy. So yesterday we have this all important so-called US CPI data that was released out yesterday. So this US CPI data is the core inflation rate that market participants are watching very closely, stripping off the volatile item like food prices and energy prices. The core inflation rate actually slipped down more than expected. Okay, market is expecting 3.3% year on year, but it came in at 2 basis point lower at 2.8% year on year. So a previous month was 3.1%. So if you were to look at the core inflation rate number over here, let's share with the trend now of the core inflation data. All right, so the core inflation data actually is to 2.8% year on year. So this is actually the lowest rate since about what 3 years back, okay, at 2.8%. So if you look at the 10-year trend, is actually decelerating, but this deceleration in this core inflation data is more backward looking because we know that inflation expectation has crept up, especially based on the ISM manufacturing subcomponent, the ISM services subcomponent as well, which I covered in the previous daily dose of market insights, and that didn't see rejoicement to the major US stock indices. So in fact, the major US stock indices yesterday actually plummeted. What we could see is the SPX is down by negative 3.5%, the Nasdaq is down by negative 4%, and the Dow Jones Industrial Average is down by negative 2.5%, and the Russell 2000 is down by negative 4.2%. So what we could see over here is a give back to the so-called that very strong intraday very strong gains that is being seen on the prior session, which is on Wednesday, where the Nasdaq added by 12% point for a single day. So that is the best, second best rally on record in the whole history of Nasdaq 100, and the S&P 500 added 10%. So that single day move is more primarily driven by the that temporary 90-day pause on the higher reciprocal trade tariffs, where US has earlier targeted to other countries, but with the exception of China. So what we could see over here is that yesterday price movement on the US stock indices, number one, it could be a potential bull trap. That means, i.e., the very strong push up on Wednesday might just be only a single day rally i.e. a bull trap, a dead cat bounce, before a potential medium-term downtrend resumes on the major US stock indices, which is primarily my base case scenario right now, based on yesterday's intermarket dynamics that I shared with you guys yesterday. Those where I covered a rather lackluster, we call it market breadth indicator on the major US stock indices. Later I'll flash that market breadth indicator in again when I cover the short-term intraday technical outlook on the major US stock indices. All right. So and also one thing is that liquidity ammo, that we know that every time when the US stock market faces a significant risk off, market expect the Fed to come in and rescue the market by kicking or giving a rather dovish guidance, that saying that there's some clear signs that they will start to kickstart a interest rate cut cycle, or do a emergency Federal Reserve meeting to cut interest rates. Right, but however, that is not the case. The Fed actually leans against inflation and away from preemptive rate cuts. So that is actually Bloomberg did a what I call it, a news report, where they compile the recent Federal Reserve officials' public speeches, stating that they are more concerned about persistent rise in inflation triggered by President Trump's tariffs. All right, still don't forget, even though we have this 90-day so-called pause on the higher reciprocal trade tariffs against South Korea, against Japan, against EU, but the base tariff of 10% still remains. And overall, what we could see is that Trump's right now, the total tariffs right now is at China at 145%, after Trump's up the ante to actually sounded his displeasure against China tit for tat measures against US. So right now, there could be some transitionary problems Trump mentioned in his what you call it, public speeches yesterday. So transitionary problems, it could be means that there could be further hostility in terms of relationship between China and US. So that also spoke the risk of impact on the major US stock indices yesterday, that causes all the major stock indices to close in the red, and is down by more than 2% for all the major stock indices. And if you look at the worst hit yesterday, were the mega cap technology stocks as usual. So we know that this mega cap technology stock is higher beta stocks, where they actually either explode to the upside based on higher explosion to the upside if we see a risk on environment. But however, if we see a risk off environment, they explode more severely to the downside. So very clearly, deeply in the red for the mega cap technology stocks, where Nvidia is down by negative of almost negative 6%, to be precise, negative 5.9%, and Tesla also got worse hit as well, because of its key factory because some of its global factory operations come out from China, Shanghai, the Shanghai production plant. So it's down by negative 7% yesterday. And Meta is also down by negative 6%. And Apple also got worse hit by negative 4% due to its so-called high significant revenue pie from its China market as well. All right, so net overall risk off environment yesterday, and based on this risk off environment yesterday, gold benefited. So if you look at gold price yesterday, it actually added 3% and broke above the previous all-time high at 3,168 level. And in today's Asia session, it added its gain by 1.34% as we are speaking right now, hitting a fresh intraday high at 3,219. Okay, 3,219 over here. All right, so three consecutive session of bullishness since the retest on its 50-day moving average that we highlighted earlier on Wednesday, where we maintain our bullish bias since our daily dose on Wednesday. So later I'll touch on what are the key short-term level to watch out for again. All right, so the key story over here is that it seems to us that also during this we call it a period of risk off in the global especially in the global US global equity market environment as per se. In the past, the dollar tends to benefit. Let's say, for example, during the 2020 pandemic, the 2008 great financial crisis, during the Lehman Brothers crisis, the dollar tends to benefit as well, together with the Swiss franc and as well as the yen itself. But however, if you look at the environment over here, is that the dollar actually worsen. All right, the dollar actually worsen across the board. Okay, the dollar actually worsened across the board. So what we could see over here is that we see throughout dollar sell off. So the one that the dollar is not selling off is against the CNH. So right now the CNH also could be used as a tool where the China top policymaker may deliberately so-called we call it weaken the Chinese yuan against the dollar. So that's why you see the dollar Chinese yuan is not weakening as much as other currency. So in fact, based on the 5-day rolling performance as we are speaking right now, the dollar CNH dollar is gaining by a minor gain of 0.4% against the yuan, because more likely is the China top policymaker try to actually weaken the yen to offset some of the negative impact that is being felt on the 145% tariffs that US hit on China exports. All right, but where else we start to see the Swiss franc gaining, the dollar loosening, the dollar weakening against the Swiss franc by negative 3.8%. And what's interesting over here is that the dollar also gaining very strong. The dollar also weakening very strong. The dollar also weakening very significantly against the Aussie and the Kiwi, which is down by negative 4% each. All right, and next up, I want to highlight to you all is the euro dollar. So the euro dollar is the dollar is actually down against the euro by close to negative 2.9%. So what's interesting over here is that I do highlight the euro dollar is very importantly, this euro dollar. It is the euro dollar. This is the daily time frame chart. Okay, sorry. Let me put it in a week. Okay, it's not here. Sorry, pardon me. Yeah, this is the euro dollar. So for the euro dollar, what we could see over here is that if we go to the weekly time frame chart, all right, very clearly the price action of the euro dollar, this yesterday price action, it broken down below this former major descending channel long-term resistance since the high of July 2008. Right, and the euro dollar now is trading at the 2-year high. All right, so what it means that this euro dollar bullish breakout, okay, as we are seeing right now, implies that the dollar is not benefiting as a safe haven refuge or a safe haven, we call it a place where in terms of systematic risk off, the dollar tends to benefit together with the yen and the Swiss franc, but the dollar now is losing its status as a safe haven currency. And one of the reasons why is because there could be a potential further rise in the US Treasury yield that could actually see further losses in US Treasury longer term bonds. All right, so what I could see over here is that the US Treasury yield continues to jump today above the yesterday above the 50-day, the 200-day, and the 20-day moving average. Right, it's going to do that very vicious bounce. And if you look at the longer term Treasury yield, the 30-year yield continues to raise also at a significant level as well yesterday, right? It's going to bounce higher. So the reason over here is that potentially in the market charter, there is rumored that China PBOC could be using one of its arsenal tool to actually further enforce its tick for tat measures against the so-called the US during this ongoing US trade and tech war that has started to intensify recently in the last few days by selling away US Treasury bond. So we know that if there's a this could actually further see further rise in the US Treasury yield. So by doing that, they're actually attempting to squeeze the US economy and create this kind of risk-off scenario in the stock market, but also preventing the US dollar to become a safe haven currency that it did in the past. So right now it creates a negative feedback loop into the global financial market. That means, i.e., there could be further risk that this US Treasury yield may continue to rise further
due to this potential rumor that China is actually using the treasury market as a tool to actually we call it counter US higher tariffs measure against China. And because of this, market participants may start to view that the bond price in US may fall further, weakening their foreign demand. All right, so that actually also causes the negative feedback loop into the US dollar that allows the euro dollar to explode to the upside yesterday, where it starts to did that bullish breakout from that major descending channel since major descending channel resistance that was previously in place since January 2008. All right, so very significant move in the euro dollar as you are seeing right now. Okay, so with that, that is the first section of the today's daily dose of market insights. So let us now cover the second session, which is the intraday technical outlook. And just right now, we are at the euro dollar. So I'll focus on the euro dollar first. All right, so starting from the euro dollar. But before that, let me expand my screen so that you guys could actually see it better. All right, over here. Okay, good. So for the euro dollar, yesterday we still maintain our bullish bias with the first resistance level to watch. With the second resistance level to watch will be at the 111.50 level. So 111.50 level mid burst to the upside. Right now, very strong. If you look at the daily time frame on the daily RSI over here, daily RSI overbought, but no signs of a bearish divergence as price action continues to seek higher high over here. So i.e. there is potentially we call it, this is a kind of more of a genuine bullish breakout rather than a fake breakout based on the momentum indicator, because the daily RSI is showing higher high. There's no bearish divergence. Okay, now back to the hourly time frame chart to see the shorter term movement. So yes, it's overbought as well. No bearish divergence on the hourly time frame as price action continues to trace out higher high on the movement on the RSI in line with the movement on the price action. But nevertheless, given this overbought, kind of an extreme overbought level, much more higher than the previous overbought, okay, because right now the overbought level is at 83, slightly higher than 81, okay, almost the same as 83 previously over here. So there could be this 83 at 3rd of April. So given that because it hit a overbought level that is rather similar to the level of 83 that was previously on 3rd of April, where the price starts to consolidate a while ago, and it's coming very close to the next resistance at 111.40, which is 114, pardon me, which is also a Fibo extension level. If I do the right, close to the 2.618%. So there could be some signs of what you call that consolidation once it hit the 1.14 level during the European session. So potential level after hitting 111.14, there could be a pullback or consolidation. So consolidation level could be this level here, which is the minor swing high of yesterday's US session, broken during today's Asia session, now turns into a pullback support. And if you do the Fibo retracement, that also coincide very closely to the 38. Okay, let me remove this. 38. Sorry. Let me remove the extension. Okay, that coincides with the 38.2% Fibo extension, Fibo retracement as well. Pardon me, over here. So what I'm trying to emphasize is that the rally is the bullish breakout seems to be not a fake bullish breakout, because the daily RSI is not showing a bearish divergence. But however, the hourly RSI now is at a rather extreme overbought level at 83, where it previously hit 83 as well during 3rd of April. You could see over here where after that the price action starts to consolidate first before staging another rebound again. So what I could see over here is that the next resistance level will be at 1.14. So during the European session, it may hit 1.14. Then thereafter, it may start to do that consolidation. So consolidation first support level to watch will be at 1.1240. Let me put it writing over here. 1.1240. Okay, Then after that, the next one will be 111.50, which is a very important level because this is actually the pullback, the important pullback support of that formerly major resistance that is being derived from that former long-term circular descending channel upper boundary from January 2008 now turns into an important pullback support level. So as long as this consolidation or dip didn't surpass below 111.50 later, so this if it start to dip, the maximum level to watch out for will be 111.50. So if 111.50 managed to survive the dip, which is my short-term pivotal support for today, we'll still maintain that intraday bullish bias on the euro dollar. After 111.40, the next resistance level to watch out for in near term will be 114.80, 150.20 next. However, if price action starts to do a breakdown swiftly below 111.50 and the hourly close below it, then yesterday's bullish breakout will be in jeopardy. That means there could be an increased risk of a failure bullish breakout to see a choppy down move to expose the next near-term support in near term for today at 110.70 followed by 10990. So in a nutshell, still maintain a intraday bullish bias on the euro dollar, but however, after hitting the 114 level, 1.14 level, there could be signs of a minor pullback or consolidation phase to take shape before another impulsive up move resume because of the extreme overbought level that's been depicted on the euro dollar now on this hourly time frame. Pullback support level to watch 1.1240, maximum 1.1150, which is my short-term pivotal support for today. Okay, so that's for the euro dollar. Up next will be the sterling dollar. So the sterling dollar also rallied and hit our resistance level as mentioned in our bullish bias that we have since the start of this week in my previous daily dose. So 130 figure 130 has been met. So with that, I will tighten my short-term pivotal support zone to 1.2925, 1.2890 for today. Former minor swing high area of 7th of April, broken out yesterday, now turns into a pullback support and also confluence with the 20-day moving average, acting as a similar support zone as well. So next resistance level to watch out for, 1.3110, followed by 1.3170 slash 1.3210, which is the minor swing high area of 3rd of April. Only a breakdown below 1.2890 will invalidate today's intraday bullish bias on the sterling dollar to see it shaping another round of choppy decline, exposing 1.28 2855, all right, 2855, which is close to the 200-day moving average. A breakdown below it sees 1.2745 coming in next, which confluence with the rising 50-day moving average and as well as the medium-term ascending channel support that is in place since the low of 14th of January this year. So i.e. in a nutshell, still maintain that intraday bullish bias on the sterling dollar for today with a tightened key short-term pivotal support zone at 1.2925 slash 1.2890 next. Okay, so next up will be the Aussie dollar. So the Aussie dollar, yesterday we do have a bearish bias below the 20-day moving average as we feel that this rebound may have come to its end already. So indeed we start to see signs of a bearish divergence on the hourly RSI, and the hourly RSI starts to shape a lower low over here. But given the persistence of the dollar strength that is being seen in the euro dollar and the sterling, so there may not be so much infliction that the Aussie dollar, it may inflict on the Aussie dollar unless we start to see a significant risk off environment in the US session pertaining to the US stock market thereafter today. Right, so even though yesterday the US stock market sell off, the Aussie dollar didn't sell off dramatically as well. So unless we start to see a reversal of fortune in the Aussie dollar today, but it seems to me the Aussie dollar right now is tracking the movement of the euro dollar. But signs of exhaustion has already been seen by this bearish divergence on the hourly RSI. So with such mixed element right now, based on intermarket correlation over here, we will be having a neutrality stance for today on the Aussie dollar, a rather tight one, using the upper limit. The short-term pivotal resistance will be my upper limit of my neutrality stance now at 62.55. Lower limit of the neutrality stance will be yesterday's US session low at 61.70. So it attempt to break below 61.70, but it can't test it and strip that bounce. All right, throughout yesterday US session and even in today's Asia session as well. Right, the bounce. So watching the lower limit at 61.70. So if we start to see an hourly close below 61.70, then potentially the Aussie dollar may start to revert back to a kind of a risk off proxy again, exposing the next near-term support level at 60.80, followed by 59.95 next. However, we start to see a sudden push up above 62.55, then the Aussie dollar will be tracking the movement of the euro dollar, seeing a further squeeze up to continue this counter trend rebound scenario, exposing the next resistance level at 63.15. Above it sees the medium term resistance coming in at 63.90/64 figure. So this 64 figure is very, very important because on the daily chart of the Aussie dollar, this is where previous rebound got rejected on the 21st of February, on 18th of March, and most recently on 3rd of April. And where it got rejected from a former major ascending trend line that was previously in place since 13th of October 2022 low that was broken down on 10th of December last year. All right, now turns into a very critical medium-term pullback resistance, which is the 64 figure level. All right, something to take note of. All right, so that's for the Aussie dollar. Then up next will be the dollar yen. Still recall dollar yen yesterday, we do have a bearish bias. So this bearish bias of the dollar yen still remains intact. After that bounce off earlier on 9th of April, and now it broken below a major ascending trend line support from 16th of January 2023 low. All right, so right now, yesterday it clearly has a daily close below this 144.80 level, so it's already shaping this major bearish breakdown on the dollar yen. Okay, so with that, what are the key levels to watch out for today and the trend bias? So the trend bias, we still maintain that bearish bias on the dollar yen over here, on the dollar yen over here. So what I'm going to do over here is, let me remove this, since this has been met. This has been met. Okay, so what I'm going to do over here is that it's now shaping that bearish breakdown over here. RSI oversold, but there's no bearish divergence yet. Okay, there's no bearish divergence on the RSI. Okay, so with that, I will have a rather tight short-term pivotal support, rather tight short-term pivotal resistance level for today on the dollar yen, using yesterday's US session rejection at the 145.10 level. Okay, 145.08. Let me put it 145.10 level. So this will be my pivotal resistance for today. Okay, let me put it in writing. 145.10. Okay, 145.10. So this will be my normal resistance. 146. Okay, so i.e. still maintaining that intraday bearish bias on the dollar yen, given that yesterday he has more or less we call it trigger that bearish breakdown after the break of that, after the daily close of that all important support level at the 144.80. I will have a tightened short-term pivotal resistance for today on the dollar yen, 145.10 short-term pivotal resistance level. Next near-term support level to watch, one-time Fibo extension taken from the high of 3rd of April at 14170/55. Also, this 14170/55 is also the swing low area of 20th of September and 30th of September. Then the next support level to go will be the 16th of September 2024 swing low, which is at the 14. If 141.55 is taken down on the downside, the next support level to watch will be 140.30/140 figure level, which is the September 2024 swing low area as well. However, if price action starts to reintegrate and have an hourly close above 145.10 short-term pivotal resistance for today, then yesterday's bearish breakdown will be in jeopardy to potentially sees a squeeze up towards the next near-term resistance at 14660, followed by the critical range resistance at 14815 level. So in a nutshell, due to the bearish element that is being highlighted on the higher time frame daily chart on the dollar yen, we will still maintain a intraday bearish bias on the dollar yen with a tightened short-term pivotal resistance for today at 14510. All right, that's the dollar yen. Up next will be the major stock indices now, the intraday technical outlook on the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 remains rather resilient at the short-term pivotal support level that we highlighted yesterday at 20,400 level mark over here. All right, so for that, then you see the hourly RSI. The hourly RSI continues to actually trend higher by shaping a series of higher low. Okay, higher low, and now inching up above the 50 level as well. Now it's at the 55 level, all right, above the 50 level. So indicating some form of intraday bullish momentum that is still intact on the Hong Kong 33. Right, so with that, we'll still maintain that intraday bullish bias, but we in more like a range scenario. So the upper limit of the range will be that breakout that the previous push up that can't clearly take out the intraday high of this Monday where the price actually gapped down. All right, so there was a push out on Thursday, then thereafter it pulled back, managed to survive the 20,400 short-term pivotal support, and with this hourly RSI that is still positive, shaping higher low, and now it's going above the 50 level mark again, indicating some form of positive intraday bullish momentum that is still intact on the Hong Kong 33, representing the Hang Seng Index. We'll still maintain that intraday bullish bias, 20,400, but we in the upper limit of the range resistance that was formed on this Monday, which is the 21,040 / 21,300 level. All right. However, if price actions has starts to break down swiftly below 20,400, then today's intraday bullish bias will be invalidated to see the reintegration back into the lower limit of this range at 19,900, followed by the range support level at 19,385 / 19,290. Right, so net IE still maintain that intraday bullish bias, but we in a range configuration for the Hong Kong 33 using 20,400 as my short-term pivotal support level. Okay, up next will be the Japan 225 representing the Nikkei 225. So the Japan 225 Nikkei 225 broke below our short-term pivotal support yesterday at 33,820 level, 33,820 level, and plummeted down, and now starts to trade sideways. And if you look at the configuration on the hourly RSI, it has also broken below a support level as well. Okay, broken below a support level, okay, and below the 50 level mark. So with that bearish momentum reading that's been seen on the hourly RSI, we will have a bearish bias for today on the Japan 225 using 34,135 as my short-term pivotal resistance level, a breakdown below intermediate support at 32,425, which got tested in yesterday's US session, may expose the next support level at 31,350, which is the minor swing low of Wednesday. Below it sees the all important Monday swing low at 30,390 next. Only an hourly close and a push up above the pivotal resistance at 34,135 will invalidate today's intraday bearish bias to see a squeeze up for the counter trend rebound phase to continue, retesting 35,190. Above it sees the 20-day moving average coming in, confluencing with the next graphical intermediate resistance zone at 36,130 / 450. So given the bearish reading that's being depicted on the hourly RSI and the breakdown below the former minor swing high of 33,800 level yesterday, we will flip to a intraday bearish bias on the Japan 225 using 34,135 as my short-term pivotal resistance level. Up next will be the German 30. So the German 30 yesterday also came down, all right, and thereafter it traded sideways after hitting the former minor swing high area, turns pullback support at around the 20,450 level. All right, 20,450 level. Okay, so okay, this area here. So the thing over here is what's interesting is here holding above the 200-day moving average. So what we're going to do over here is that it seems to us that it may start to do a bit of messy sideways range right now. So with that, no conviction of any direction movement right now, given that previously it got rejected from the high of 21st of this level here at 21,610. And if you look at the daily time frame chart, okay, the price action was the daily candle is rather bearish. All right, over here after it rejected this descending trend line that I drew from the high of 26th of March. All right, from here. So with rather mixed element, and I do not have the conviction to maintain that bullish bias for today. So I rather have a neutrality stance right now. So it could start to trade sideways between the lower limit of 20,450 that it managed to survive during yesterday's US session, and the upper limit will be the high that's being made on Wednesday US session at 21,610. Okay. Okay, so given the bearish candlestick that's being seen on the daily time frame chart, no conviction of maintaining yesterday's intraday bullish bias on the Germany 30 representing the German DAX. So for today, I will flip to a neutrality stance, neutral between 21,610 and 20,450. I'll be watching very closely the lower limit at 20,450 because this index seems to be tracking the movement of the major US stock indices once the US session opens. So if the major US stock indices starts to turn weak today, potentially the Germany 30 may get inflicted on the downside. So a breakdown below 20,450 may expose 19,970 next, which is the 200-day moving average, acting as a similar support level as well. A breakdown below 19,970 may start to see the continuation of the previous impulsive down move. In first step, retesting the all-important Monday swing low area, 19,310 slash 18,935. All right, so watching the lower limit of the neutrality zone at 20,450 for the Germany 30. Up next will be the US major stock indices. So before that, let's take a look at the market breadth indicators, which I highlighted yesterday, why I'm not convinced of that single day strong rally that's being seen on Wednesday, where Trump announced that 90 days temporary break for the higher reciprocal tariff for all countries except China. Okay, let me open up that market breadth indicators again. Okay, give me a minute before I touch on the short-term intraday technical outlook on the major US stock indices. Okay, why is it so slow? Yeah, good. Okay, so this is the market breadth indicator. Okay, using the 20-day, the percentage of Nasdaq 100 stocks above that 20-day moving average. Notice that the Nasdaq percentage stocks above that 20-day moving average continues to trend lower by printing a series of lower low despite Wednesday push up. But even though Wednesday push up is at 31%, now it dipped down to 11% yesterday. So indicating there was a bearish reaction at the Nasdaq 100 20-day moving average, and there are lesser and lesser stocks that are able to maintain above their 20-day moving average in terms of percentage. So indicating very, very weak movement on the US stock market yesterday. Why I use the Nasdaq 100? Why not Dow Jones? Why not S&P? The first step, because the Nasdaq 100 is always the leading index in the US stock market. So I will say that because it's high beta and heavily concentrated on the mega cap stocks, where global stock traders and global fund managers have a high concentrating holdings on them. All right, so that's why I always look at the Nasdaq 100 as a leading sign. Okay, so the percentage of Nasdaq 100 stocks above the 20-day moving average slipped yesterday to 12%, which is a very weak number, indicating that lackluster market breadth in the Nasdaq 100, which does not support the start of a medium-term bullish reversal at all, despite that so-called tremendous rally of 12% that's being seen on Wednesday. Similar for the percentage of S&P component stocks above their 20-day moving average, also plummeted as well, inch down lower, okay, lower high, and yesterday it went down to 10%, right? 10%, it dipped down to 10%. So also indicating a rather weak market breadth environment in the S&P 500. All right, so with that, we will flip to a intraday bearish bias. So yesterday we were neutral on the US Wall Street 30. So for today, we will slip to a intraday bearish bias on the US Wall Street 30. First near-term resistance level to watch will be at 39,900 level, which got rejected in the middle part of yesterday's US session. I do not want you to use this 39,900 level to be my pivotal resistance level, given the rather high volatility that's being seen in the US session right now, every time when the US stock market open because of the wild swing. So later there could be also a wild swing as well due to a risk event that is more pertaining to the US session later, which I'm going to highlight to you guys. Right, pivotal resistance will be at the 20-day moving average at 41,180. Next near-term support level to watch, 37,900. A breakdown below it, revisit today's this week critical low area, which is the Monday swing low that got managed to survive on Wednesday, right before the announcement of that 90-day tariff reciprocal tariff break by Trump, 36,790/400. So we're flipping to an intraday bearish bias on the US Wall Street 30 using the 20-day moving average as a short-term pivotal resistance level at 41,180. Only a breakout above 41,180 revives the short-term bullish tone to expose the next near-term resistance level at 42,400, followed by 42,885 with confluence with the 50-day moving average. Next up will be the Nasdaq 100. So the Nasdaq 100 also got rejected exactly at the 19,280 short-term pivotal resistance level. Now, yesterday we were neutral as well. So we will flip to an intraday bearish bias on the Nasdaq 100 using 19,280 short-term pivotal resistance level. First support level to watch that managed to survive, 18,130 right now. A breakdown below it exposes 17,410. Then thereafter, if 17,410 is broken down on the downside during the US session, it may expose the Monday critical swing low area at 16,590/16,335. Only a bullish breakout above 19,280 may revive the bullish tone to see the continuation of that mean reversion counter trend rally extending on the upside, exposing the next near-term resistance level at 20,350, which confluence with the 200-day and the 50-day moving average, acting as a similar resistance level as well. So that's for the Nasdaq 100. Switching to a intraday bearish bias using 19,280 as my short-term pivotal resistance level. All right, so that sum up the intraday technical outlook on the broad-based stock indices. Let us quickly go to the major commodities market, starting with gold XAU/USD. So gold XAU/USD, yesterday we maintained our bullish bias, hit our resistance level at 3,210. All right, in today's Asia session. So with that, the RSI is at a rather extreme overbought level, but no signs of an exhaustion as it continues to print a series of higher high, no bearish divergence. So potentially there could be a minor pullback. So we are having a rather tight short-term pivotal support level for today for this minor pullback at 3,163, which is the former all-time high area, now turns into a critical short-term pullback support level. So as long as 3,163 short-term pivotal support holds in any form of a minor pullback for today, we'll still maintain that intraday bullish bias on gold XAU/USD. Next two resistance level to watch based on Fibo extension clustering level, 3,250 followed by 3,200. 2380 next. Only a push down and hourly close below 3,163 may negate today's bullish bias on Gold XAU/USD to see a deeper minor corrective pullback taking shape, exposing the next near-term support level at 3,135, followed by 3,090 next. So IE still maintaining that intraday bullish bias on Gold XAU/USD using a tighten key short-term pivotal support level at 3,163. Lastly will be the West Texas crude oil over here. So the West Texas crude oil over here, yesterday it came down, traded sideways, but managed to survive at the short-term pivotal support that we highlighted earlier on at 58.30. So now the RSI also managed to hold above a ascending trend line support as well from here. Okay. So with that, we still watch 58.30 as my short-term pivotal support level on the West Texas crude oil for here. So potentially there could be still a chance of a minor bounce taking shape. So first resistance level to watch for this minor bounce for today will be this level here. Okay, let me put it in writing at 61.66. Oops. Okay, why is it so slow? Okay, good. 61.66. Okay, followed by the range resistance that can't break out since Tuesday high, which is 63.36. Okay, however, if the price action starts to see a breakdown below 58.30, the intraday minor bounce scenario will be invalidated. Then we will start to see the start of another impulsive downward sequence, exposing the next support level in first step at 54.50/53.80. So still maintain that intraday bullish bias on West Texas crude oil, but only for a minor bounce scenario rather than the start of a medium-term bullish reversal, using 58.30 as my short-term pivotal support level for today. All right, so that sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? Today is rather important, and I'll explain to you all why. So for Friday, today what we have is that we do have in UK at 2 p.m. the GDP, monthly GDP for the month of February. Market is expecting a recovery to 0.1% month of month. So that could potentially impact the sterling dollar rate and the sterling crosses. That's 2 p.m. Singapore time. And also at 5:45 p.m. Singapore time, we have ECB official president, non-official ECB President Lagarde speaking. So that could impact the euro dollar movement and the euro crosses. That will be at 5:45 p.m. Singapore time. And up next, we have another tier 2 inflation data number up from US at 8:30 p.m., which is the core PPI number. So this is more like a cost of input cost for doing business in the US. Up in March. So markets are expecting an increase to 3.6% year on year from 3.4% that was printed in February. All right, so that's 8:30 p.m. Singapore time. And after that, you have the 9 p.m. we have another Federal Reserve. We have a Federal Reserve official speaking, Fed Collins, and the all important one of the tier 1 leading economic indicator will be the preliminary consumer sentiment data conducted by University of Michigan. So this is very important because it reflects retail spending in the US. That means, i.e., also we know that retail activities or services or activities constitute 3/4 of US economic growth. So this consumer sentiment has been plummeting since the start of this year. Market expecting another weak number of 54.5 below 57 that was printed in March. And also within this consumer sentiment survey, they also poll inflation expectation, 1-year inflation expectation, and 5-year inflation expectation. So all these numbers has been inching up higher as well. So that actually give rise previously in the last few weeks of that increasing stagflation environment in the US economy. So that's 10 p.m. Singapore time. Then at 11 p.m. Singapore time, we have Fed Williams speaking, and other Federal Reserve officials. And before we go, right, Also, another important day today pertaining to US stock market is the start of the unofficial start of the Q1 earnings season in US, where four major financial institutions are reporting their Q1 numbers at between 8 p.m. to 7 p.m. Singapore time before the start of the US stock market. JP Morgan, Morgan Stanley, BlackRock, and Wells Fargo. So market participants will be pretty much looking forward to their forward guidance, especially this latest round of trade tariffs situation implementation by the US White House in the last few days. All right. So that sum up today's Daily Dose of Market Insights. I'm Kelvin here. I wish you a great day ahead and a restful weekend as well. And we shall speak again on Monday. Thank you very much.